All right, let's talk Abercrombie and Fitch. They just dropped their latest quarterly numbers, and on the surface, things look pretty good. I mean, it's their 12th straight quarter of growth. But once you start digging in, you realize the real story here is, well, it's a tale of two completely different brands, plus a huge tariff storm brewing on the horizon. So let's get into it.
Okay, first things first, the headline number that everyone's buzzing about. Earnings per share came in at $2.36. I mean, that's a solid beat. And how'd they get there? On the back of record third quarter sales. We're talking $1.3 billion, up a healthy 7%. What's really telling is that management hit the high end of their own forecast for both sales and operating margin. That's strong execution, plain and simple.
All right, so to really get what's going on with A&F this quarter, you've got to split the company in two. Think of it like this. You've got Hollister, which is just this powerhouse growth engine, and then you have the Abercrombie brand itself, which is this massive turnaround story that, believe me, everyone on the street is watching very, very closely.
And wow, look at this slide. The difference is just stark. Hollister is on an absolute tear, posting a 16% jump in net sales. That's huge. Then you look at the other side, the Abercrombie brand, down 2%. Now you might think, oh, that's bad, but here's the key takeaway, and this is super important. That negative 2% is actually a huge improvement from where they were in the first half of the year. The bleeding has slowed way down, and that's exactly what investors were hoping to see.
So let's drill down into Hollister for a second, because this momentum is it's undeniable. The CEO, Fran Horowitz, pointed out that this isn't just a one-trick pony. The growth is really balanced across men's and women's, and it's coming from great traffic, both online and in their actual stores. But here's the best part. They're getting a higher average unit retail, or AOR. All that means is they're selling stuff for more money because they don't have to slap discounts on everything. That's the sign of a healthy brand for sure. Okay, so flipping over to the Abercrombie brand, the name of the game here is one word: stabilization. Management has been absolutely laser focused on cleaning up their inventory, and it looks like it's in a much, much healthier spot now. And why does that matter? Well, it means they can get better prices, and they're not just running a giant clearance sale all the time. The traffic is still positive, which is a great sign. People are still showing up. So the big goal, the thing to watch, is can they get this brand back to flat sales in Q4? If they pull that off against a record-setting quarter last year, that would be a massive, massive win.
All right, so we've talked about the brands, but there was another huge topic on the earnings call, kind of the elephant in the room, and that's tariffs. This is the big looming risk factor that could really impact the all-important holiday season. And get a load of this number, 360 basis points. Management is literally bracing for a 3.6 percentage point hit to their operating margin just in Q4. To put that in perspective, we're talking about a $60 million impact. Yeah, $60 million. So this isn't some minor headache. It's a major, major cost pressure they absolutely have to deal with. So what are they going to do about it? Well, they're not just sitting on their hands. They laid out a really clear three-part playbook. First, they're moving production around, diversifying their sourcing so they're not too reliant on any one country. Second, they're using their size to go back to their vendors and negotiate better costs. And third, they're planning on some targeted price increases, but smartly, they're waiting until after the holidays to roll those out on new stuff. That's their plan to fight back against this headwind.
Okay, so we've got the good, the bad, and the plan. What does it all mean for the holiday season and the full year? Let's check out the official guidance, because this is where management tells us how they see the future playing out, even with all that tariff pressure.
And honestly, this guidance is pretty interesting. It signals a whole lot of confidence. Look at the full year. They actually raised their sales forecast to the high end of what they said before, now expecting 6 to 7% growth. But what's even more impressive, to me anyway, is the Q4 operating margin. They're guiding to around 14%. That is a really strong number, especially when you remember that it already includes that huge 3.6% tariff hit we just talked about. That's pretty bold.
Here's another huge signal of just how confident they are. They're doubling down on returning cash to shareholders. They're aiming to buy back $450 million of their own stock this year. That includes another $100 million just for Q4. I mean, when a company aggressively buys back its own shares like this, it's basically screaming, we think our stock is cheap. It's a classic move.
Okay, so that's the quarter in a nutshell. Now for the fun part. Let's put all these pieces together and figure out what our call is on the stock. This is our thesis, and what we're going to be looking for going forward. So, here's the billion-dollar question, right? What do you do with all this? You've got Hollister just firing on all cylinders, you've got the Abercrombie brand finally stabilizing, and you have a management team that seems to be navigating some serious headwinds with real confidence. So, what's the call?
Here at Talk Tickers, we're initiating with an outperform rating. We just think the story here is too compelling. We believe the market isn't fully appreciating just how strong and durable Hollister's growth is, or how quickly this Abercrombie brand turnaround is actually happening. And our call really rests on four main pillars. First, Hollister isn't just growing, it's a dominant force that's actively stealing market share. Second, the Abercrombie brand has stabilized, which takes a huge question mark off the table for investors. Third, those aggressive buybacks. That's management putting its money where its mouth is. And finally, they've shown us they have a solid plan to handle the tariff situation, which really helps to de-risk things going forward.
So, if you're looking for a way to play this, here's an idea: a classic pairs trade. On one side, you go long Abercrombie & Fitch to bet on their great execution, but at the same time, you short one of their competitors. Think of one of those other teen retailers you see in the mall that just doesn't feel relevant anymore. By doing this, you're not just betting on A&F, you're betting on the divergence between a winner and a loser. It's a neat way to isolate their outperformance while hedging some of that general market risk.
So that's our breakdown of Abercrombie & Fitch's quarter. You've got a company with real momentum and a team that is clearly executing at a very high level. The big question we'll all be listening for on the next call is this: can the Abercrombie brand finally tip back into positive growth? Because if it does, this isn't just a turnaround story anymore. It becomes a true two-engine growth machine. And as always, remember, this is not financial advice.